Good afternoon, good evening, good morning. Welcome to Develop Your Edge with Anthony Crudele. I'm your co-host, Tom Schneider, CMT with NinjaTrader. And before we get into the good stuff, I do want to remind everybody that futures and options trading contains substantial risk, is not for every trader. You could potentially lose all or even more than all of your initial investment. And that's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose, doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results, and what we talk about here on this show does not contain trade recommendations nor financial advice and should only be used for educational purposes. With that out of the way, as it is every Thursday morning, it's my pleasure to welcome Anthony Crudele back to the show. How you doing, Anthony?
Doing great, Tom. How are you? And how's everybody out there doing? Thanks for tuning in, everybody.
Yeah, I think we're having a great week, and thanks for everybody for coming. Beautiful day here in New York, a little chilly, probably not as warm as where you are, Anthony.
It's never as warm where you are as it is here, Tom. It's always smoking hot in Southwest Florida. That's why I love it.
I love it. I love it. And half of it's due to you being there. So I love it. Yeah. So what's going on? We have a great topic. This is something that, talking about the VWAP bands and VWAP in general, I think is such an interesting topic for and necessary for intraday traders.
Yeah, today we're going to talk about using standard deviation lines around the order flow VWAP, and it's going to be an anchored VWAP. And what an anchored VWAP means that you just anchor it to a specific bar, or you can anchor it back a specific time. And I'm going to use it today on the 3-minute chart because we're going to talk about intraday trading and using standard deviation lines around a VWAP. And what are a standard deviation lines? It's 1, 2, and 3 standard deviations around the order flow VWAP. And why would we look at them? What would be a reason for a trader to have them up on their chart? And I look at them as simply temperature gauges. How strong of a move is it? How far away from a VWAP are we getting? Are we rotating off of standard deviation lines to come back to the VWAP? I mean, there's a lot that you can use with these standard deviation lines for mean reversion, for targets, for stops. There's all sorts of ways you can use them. And I'm just going to go over today a simple guideline when using them and how I think a simple way of looking at them is. And hopefully the traders out there can take what I show them today and put them into play into your strategy, because I don't consider this a strategy that you would use on its own. I mean, I do in some respects. You're going to need some confirmations built around it, but it gives you a great visual representation, a temperature gauge, if you will, of what's happening in the market.
Yeah, I agree. There's multiple reasons to use the VWAP bands. But before we, kind of jump into it, can you just go over what VWAP not just stands for, but maybe how, why it's important? What are people using the actual VWAP for?
Well, the VWAP is the volume weighted average price, and a lot of people are going to be looking at the VWAP to see, similar to what they would look at it as a moving average. Are we holding above it? Are we holding below it? Is the market respecting the volume weighted average price of wherever you have it anchored to? And the reason why it's important is because it's really a measurement of the market's performance versus where the volume weighted average price is, right? If the market is outperforming the volume weighted average price, it's showing strength. If it's not, it's showing weakness. And so today, when you look at standard deviation lines, it will gauge how strong of a move you're looking at. Now, obviously, for us as day traders, as most people are tuning in today are going to be day trading, a lot of what I'm going to use the standard deviation lines for is to determine what type of a day it is. And I'm going to look at these lines specifically for targets and for stops. I don't really use them as much for entries. I'm going to show a little bit about that, but you're going to look at them and see when you see the VWAP and you say, okay, how far away are we getting from this volume weighted average price for today? And it will give you a big look, a look on how strong of a potential trend day we're having. I think that's the number one thing that I will look forward for. If it's a range day, what are the standard deviation lines doing? Are they just totally sideways and they're just not moving? And I find them very beneficial for range days because I'll use the standard deviation lines for entries, targets, and of course stops as well on range days. I really like them for range days when most people are getting chopped up. I'm just waiting to see if we can get one or even two standard deviation move away from a flat VWAP. Because to me, on those days, if I think it's a sideways day, if you get a 2 standard deviation move away from a volume weighted average price from the open, that's most likely going to be a time where we have a mean reversion, right? Because it's most likely a range day. You don't want to use standard deviation lines too much for fighting against a trend in a trend up or a trend down day. Then you want to use them for targets, areas to reduce positions, places to trail stops.
Yeah, I like that. I think, you're right about the trending days, using them for targets. The great thing is you can attach your orders to those bands, right? So if you want to attach it to a third standard deviation, second standard deviation, as the VWAP moves up, so do the bands, so does your target, giving you a little bit more out of the trade.
Yeah, exactly. I think let's start at the charts today. Let's get in there a little bit early. And what I have up is I'm starting off with the micro E-mini NASDAQ. And what I'm looking for here is something I've talked about quite often on this show is, first off, I take a 3-minute bar. People always ask me, why do you choose a 3-minute bar? Because for my time frame, I feel like a 3-minute bar on the opening 3 minutes. I just like that for the opening range. Some people will look at the opening 30-minute range. Some people open the 30-second range, opening range for 30 seconds. Whatever your time frame is, that's definitely a personal choice. I tried to be a little bit on the active side, but not too active. And so I like to watch the first 3 minutes, add the order flow anchored VWAP to it. And here I'm going to just double click on it and just give you an idea of what we're looking at. So first off, the session, I have it just click to the session. And that session is the CME US Index Futures Regular Trading Hours. That's the RTH. And I have a 1, 2, and 3 standard deviation set up around that. The order flow VWAP is going to be red when we're below, green when we are above, just an indication of color, right? If we're above it, we're bullish. It's going to look green. You can make it whatever colors you want. I just use the standard ones. And of course, we want everything to update on each tick. It's extremely important, I think, to have everything update on every tick, especially when you're intraday trading, because you want to get the most amount of information possible. Now, additionally, I have the cumulative delta and I also have the RSI. I keep that really only on the NASDAQ a little bit because the NASDAQ, not the order flow, I keep that on all of them, but the RSI, I'm not using as much intraday on the other markets, maybe like the S&P or the Russell, because they tend to not get as overbought or overextended as much as the NASDAQ does. So I really like this more on the NASDAQ than I do the other markets. Because the S&P, sometimes I've noticed that it can stay overbought or oversold for a lot longer. The NASDAQ has these flash moves higher. So I like to keep an eye on that when looking at standard deviation lines. And the cumulative delta, we've talked about that in previous shows. It's just showing the order flow, what's bought and sold on the bid and offer. It's the net volume. So today is negative 3,100, 3,200. Now, Let's get into just the basic things that we have here. Maybe I make this a little bit wider so we really get hyper focused on these standard deviation lines. First thing that I like to look at is that opening 3-minute range. I tag that, just hit the F6 on Ninja, and you can draw a horizontal line to the top and bottom of the 3-minute. And the reason why I do that is because I want to get that gauge of where the opening 3-minute range is, and then that order flow anchored VWAP is going to be right to that 3-minute bar, and then I watch. And so it takes a little time for this to develop when you're using standard deviation lines. I want to say the first thing I would tell you is don't look at them in the first 10 to 20 minutes because the market is so volatile at that time. A 1 to 3 standard deviation move around a VWAP in the opening 10 to 20 minutes is not really a good indication of the day. So if you're like, oh, it just clicked up to the 3 standard deviation, I'm going to look to short it. It's one of these things where you've got to let it kind of set up a little bit. It will actually create patience for you to see what type of day it is. I know we're all in a big rush when that bell rings and we want to get going, but this also, I think, will help you slow things down to see where these standard deviation lines are relative to the VWAP. And the first thing I'll start to look at is, okay, if that VWAP is starting to push through that top of that first horizontal line like it is today, the first thing it's telling me is that the VWAP is now getting above the opening 3 minutes high price. I'll say that again. The VWAP is now getting above the opening 3 minutes highs price. So that means that the order flow VWAP is now getting above that opening 3 minute surge of volume. And the volume weighted average price, as you can see here, 3, 6, 9, 12 minutes into the day, volume is building to the upside substantially. So the volume weighted average price for this day is already above where we opened. Now, why do we look at the open so much, and why does that matter, especially when you're looking at standard deviation lines? Because the open is basically it's the time when the market is going to get the biggest punch of volume, the greatest surge of traders clicking in and out of the market. If you look at the beginning of a hockey game, if you look at the beginning of a boxing match, if you look at the beginning of a soccer game, it's kind of interesting. A lot of times you'll see a boxer get knocked out potentially right away. You can see potentially a goal get scored right away, or, whether it's in hockey or soccer, that adrenaline is really high. So everybody is coming in with a very strong intensity and they're getting a feel of the opponent. That is the same reason why we look at opening range. And so when you get that punch, that push, you then can now look at it and say, who took the hit? Who is the strongest hitter? Who is the one likely to win a boxing match? Think about it from this perspective as well. Wouldn't you want to see the first round of a boxing match to then make your bet, right? In this case, make your trade to know that information, who's the stronger hitter, who took the first hit, and get a sense of what's going to happen versus going in and betting on a boxing match before you saw that first hit and betting on a trade before you saw what's going to happen. And that's why that's so important. And so standard deviation lines, when they come into play, is now they show you how big of a hitter is this going to be, right? And that is going to be dependent on a lot of things that happen throughout the day. So you're going to have to wait and see this. And as the day sets up, they're going to start forming around that order flow VWAP, as you can see now. And you start to get a breakdown to see how much of a surge the market was able to take. And so let's look in here a little bit. Maybe I bring you in, Tom, to talk about, I think, just discuss anything that I've mentioned so far.
For sure. And that analogy you made with boxing and hockey and soccer, I've never thought of it like that. So thank you for that. That's a great way to look at it. I remember going to a hockey game and 6 players were already in the penalty box for fighting a second into the game. That was a rare thing, but you knew it was going to be a wild one. Here, though, what I want to point out is, or ask you, Anthony, you notice that first bar, that first 3 minute bar, we're calculating VWAP, right? We're calculating that volume weighted average price, and it starts towards the higher end of the bar. Does that give you any insight as well? Like, we're going to be up here because a lot of the volume traded around these prices at the top rather than at the bottom. Does that, even in the first 3 minutes, can that give you some insight as to where the direction of the market might be based on where that VWAP is, or do we have to wait till the next bar to kind of get a sense of where it's going?
Here's my thoughts on this. The over anticipation of something like that gets me already with a hidden bias. So my initial thought is, don't look at that. That has been one of the things I've noticed. And I think anybody who's a trader out there, one of the things that we're really, really good at is really pattern recognition, right? And so we'll look and say, wow, that VWAP is at the top of that bar in the NASDAQ. But once again, the reason why I draw the horizontal lines is to create that patience, right? I mean, I don't need them necessarily there to know if it gets above or below, but I do it to keep me in intact to know that, is this going to be a day we stay inside that opening range? Is this going to be a day that can they really force their hand and push the market above it with the VWAP or below it? And so it forces me not to look at that. And that is a great question, because, and especially for the NASDAQ, I think it's probably the least one that you'd want to look at, because there could be, a bunch of contracts that trade literally right at one price. And because it's could be potentially thin on that first bar, that might just overwhelmingly give you a false reading potentially. And you look at the Russell, and I like to look at all of the indexes as well. And I'm going to explain why I look at all of them because of this. You look at the Russell is right in the middle, kind of makes sense. That's that market's usually pretty split with volume. But look at the S&P, actually was near the top of it. And sometimes it can be a really strong indication of it. And other times, like I said, it could just be very misleading. But that's why you draw the horizontal lines.
Like it. Yeah, no, that's great. You're right about pattern. We try to anticipate, and maybe anticipating doesn't always serve you correctly, right? Because of that bias. And I like the idea that your horizontal lines force you to wait and see what happens.
Yeah, and this is another reason why when you look at standard deviation lines, now I'll get into the nitty-gritty a little bit about how I use them. And it's going to be dependent on the type of day that it is. So the first thing that I will look at is across the board. I trade S&P, Russell, and NASDAQ. I don't trade the YM, so I look at these three. And the first thing I'll look at, and I'll say, okay, what type of a day is this setting up? We're gapping down, and all of the VWAPs at this point, the Russell was the lagger. It's been the lagger all year. All of the VWAPs are getting above the opening 3-minute high. First thing it tells me is you're not looking for shorts on standard deviation lines. You are only looking for them as exits. So first thing, if all of the major indices, order flow VWAP is above the opening 3-minute horizontal line, that opening 3-minute high, you are not using the standard deviation lines for shorts, for mean reversions. I'm only looking at them for covers, period, the end. Now, I am using the lower standard deviation lines as entries all day, because those are the opportunities. That's where you find a little bit of those juicy trades, and I like them for entries a lot. So on a day like today, what I look for is, first off, let's stay with the S&P here. You finally got that surge, and potentially for me, what I would do a lot of times is once that VWAP gets above it, I buy the first retest of the VWAP, scale out for a quick scalp at standard deviation 1, standard deviation 2, leave a trailer, and most of the time I will watch to see if it can stay above the opening 3-minute range high, and I will put a stop somewhere below the first standard deviation and watch it, right? Once I start to see that the market starts to consolidate here, you're most likely going to get a stop out and then watch to see what happens if it holds the first and second standard deviation lines with the order flow VWAP staying above the opening 3-minute. So now you have a situation where you had that initial long cover, trailed stop. You could either put it below the VWAP, or I put it below a 1 standard deviation line, because you always can get back in. People forget about this, right? People are like, oh, I just want to stay long. The VWAP's above it. A lot of times I'll get stopped out here, watch it ding the second one in this area, step back in and be long. And now my stop is clear, is just below the second standard deviation. And then that's the juicy movie catch. And then once again, I'm using the standard deviation lines in an up day. The VWAP has become basically nothing to me now. I'm not using it for entries. I'm not using it for that at all. I'm only using the pullbacks below the VWAP on a trend up day, which stops below most likely the second standard deviation, because you're not likely to see a 3 standard deviation down move in an uptrend day. It's a very unlikely, right? But a 2 standard deviation move relatively early is very possible on a 3-minute bar. So therefore I trigger my stop below there, and my entries are there, and your targets are 1 and 2. And you're basically just trading the range around the VWAP. So many people will get so focused on just looking at the VWAP that they look at that as the entry. Well, everybody has that information. Not that everybody doesn't have the standard deviation lines. But remember, everybody that's looking at their dome or they're looking at their chart is most likely got a VWAP up. And it's a good tool to once again, to gauge sentiment. But I don't like entries off of it, because the entries off of it, besides my initial one when it's above the 3-minute, just to get in for a potential trend day, the rest of the time it's too crowded of a trade. So what I look for is the little squeezes below it And those are the ones where they can't hold it. They squeeze you out or they get squeezed out, and that's your entry in with a really tight stop. Because remember, as traders, we're always looking for the least amount of risk with the most amount of reward. Now, a lot of times you're not going to get these trades, but on a day like today, you do get them, right? And let's go and look at the Russell. And here's a situation where a very different looking day, and you see these on the S&P a lot. What happens with the Russell is the Russell stays sideways here the whole time while the S&P and NASDAQ's going higher. And what I think really gets interesting is that this wouldn't be a market that you can really trade today, at least from my perspective, using standard deviation lines. If anything, you're waiting to this area maybe for mean reversions off of 2 standard deviation or 3 back to VWAP. It's really just a choppy look. It's something that on a potential range day I would look at. And just to be clear, what I'm saying is when that VWAP's in between the 2 red lines, you could use 2 or 3 standard deviation lines as shorts with stops above there for reversions back to VWAP. So VWAP, once again, not an entry, potential target for a mean reversion. And like I said, here it's just really so tight. There's just very little there. But when it eventually gets above it, this is where it gets interesting to me as a trader who's trading the S&P or the NASDAQ. One of the keys is when you have all of the indexes working together now on a trend up day or a trend down day, now all of a sudden you might see an acceleration in the NASDAQ and S&P when the Russell starts to participate. And some people may say, well, why does that matter, Anthony? The Russell stocks aren't in the S&P. They're not in the NASDAQ. It matters because when you see buying across all of the indexes, that's a time where you really are going to see probably full participation and a cleaner move to the upside. So you are just not even looking at any shorting on standard deviation lines. And now you're looking for the outer standard deviation lines to potentially get tested. So let's go back and look at the S&P around 1020 in the NASDAQ. And when you look right here, 1015, 1020, you see things start to accelerate. The Russell is now participating. The S&P is now looking to test the outer bands. So if you bought anywhere in here, you now start to get, I hate to use the word greedy, but it kind of is the word. You want to now be looking for the outer bands to get tested because you have a Russell now participating in the same thing you're seeing in the NASDAQ. So the strength of the rally is really picking up steam, right? Let's go back to the NASDAQ, right around 1015, 1020. Let's take a look at it. I have this a little bit wider. You could see here, it was already at the upper part of its boundaries, but now on the retest back with the Russell above, it never even gives you a chance to go back to 1 standard deviation below. And sometimes maybe in this situation, if you see the S&P pushing higher, you want to step in and buy the NASDAQ because it is the strongest market. And then you use the VWAP entry on this market because now you've passed the time where the Russell and S&P have come into play and where they are both above their VWAP and their VWAPs are above the opening range high. And now you look for 1, 2, and potential 3 standard deviation tests in the NASDAQ. And so as you can see, it gives you a great visual representation of what the day is. Like today is a gap down, is a trend up day. I'm only looking for longs.
So, Anthony, in this case, as time goes on, right, we know the bands get wider, right? The bands off of the VWAP get wider for the most part. Sometimes they don't get wide. They just keep that distance. And today is actually an interesting thing where, yeah, they do kind of keep their distance. But in a range, in a trending day, you'll see those bands get farther apart. Is that a possibility where, like you just pointed out in the NASDAQ, you're not going to, you haven't gotten that 1 standard deviation band to the downside, and we might not get it the rest of the day. Would you ever adjust like, hey, we tested the VWAP. That might be my entry point after a certain point of the day where as we've got this, we've identified the trend since the opening 3-minute bar. It might give us a better chance to participate in a long trend.
100%. I see people in my YouTube chat talking about VWAP is where the most amount of the chop happens for sure. And that's exactly right. But remember, sometimes that retest of the VWAP on a trend up day, when you have full participation across the indices, you buy the strongest market at the VWAP, it spends almost no time there. And so technically it may not even really have tested it. It might have just gotten above it and held. And so now you're in a situation, if you really are just trading the NASDAQ or the strongest market of the 3 or 4, you then potentially look at that with a 1 standard deviation stop. But this is never going to be one of my favorite trades, because this is really 1R to 1R. It's equal risk to reward. I'm going to buy it here with a 1 off to the standard deviation, the 1 standard deviation with a stop just below there, because I can't put my stop below the second standard deviation and anticipate that big of a move to the upside when majority of that move is made. Right. And so you have to look at it always as well as, what is my upside versus my downside, right? I think people get hyper focused on the entry, but then you have to look at it in perspective and say, it's not a great opportunity. It's a way to potentially participate, but this is quick in, quick out. It holds, goes to standard 1 deviation. Most likely I'm out of 2/3 to 3/4 of that trade. And I might even move my stop just below the VWAP, because it's not a great look. And going back to what the person in chat said and what I have said, the VWAP is where a lot of the chop occurs, because you get there and it's like, what do I do? It's the Chris Farley thing, right? Where it's like, right, what do I do at this moment, right? Do I want to step in? Do I want to do something? And it's not a place where people want to really participate. A lot of times it's a place where people are forced to participate. And that's why it ends up becoming a volume weighted average price, right? And so I like the squeezes around it for entries and exits, and I like them for stops. For me, that's really where the juicy trades come from. And it also, one thing I want to say before we get to the Ask DYE question of the week is, give you an example here. Let's just go back to the S&P. Let's just say that hypothetically you have a resistance level at, or a support level at, and let's just put up a hypothetical line. So I'll hit your F6, and you look at it and you say that you have a resistance level at right here, right? So let's 41.65. It's a nice, easy round number, right? And you look at it and you're sitting here long and you're going, that's my target. Well, this is where I come in and say that these lines could help you, because you've already got a 2 standard deviation above the VWAP. You're really trying to squeeze 2 to 3 more bucks up near these areas to try and get that 65. Why? Right? I mean, yeah, maybe you'll get it. And I'm not saying I have resistance there. I'm just saying hypothetically. Or hypothetically, you have support right here at this other red line at 41.50. And you have a 1 standard deviation line that comes in at 51 or 52. And on an uptrend day, you want to buy at and above prices, right? So you potentially, for an entry, you're not going to get the best entry. Going back and looking at the NASDAQ, never gave you a 1 standard deviation move. So I like these to help guide me around support and resistance lines as well, because it gives me a great visual representation of the day, of the now, what's happening here with the volume weighted average price anchored to the open. And what is that day looking like? What does a 2-3 standard deviation move look like around that VWAP? And so it really helps you become a better executor more than anything.
Awesome. Thanks for that, Anthony. That's really, really well explained. And combining them with support and resistance levels, I've always wondered, which one takes precedence, or which one might take precedence. Obviously, nothing's 100%, but that makes sense because it's reflecting what's happening now. And, it's based on all the trading activity today, right? Rather than a level that might be based on yesterday's trading or some areas of interest and activity from previous days, previous weeks. So really interesting to know that. But you did mention Ask DYE. So I know we're coming up against time. I want to get to that question. By the way, if you are watching and you have a question for Anthony, you can send a message via Twitter using the hashtag AskDYE. Also be sure that you're following NinjaTrader at NinjaTrader. Because if we pick a question and you're living within the United States, we'll send you a gift for participating. But this week's question comes from Shy Girl. Which do you prefer trading, E-mini or micros? What are some of the advantages of each? And I'm sure we can probably do a whole show on that, Anthony.
You know what, Tom? I think we probably should, and that's a great question. First off, what is a micro versus a regular E-mini? And it's funny, we've come so far in product. When I first traded on the floor, we used to have doubles. The S&P was actually $500 per handle. Then they reduced it to $250. That was the big contract. And then the E-mini came out, and that's $50 a handle. And then you have the micros, which is 1/10 the size of that, which is $5 per point per handle. All right. If you don't know what a handle is a point. And so the differences, obviously, and the benefits of the micros versus the E-minis is being able to control risk more precisely. That's the key difference. And with a micro, I specifically use the micros for the NASDAQ because I like to scale in around prices. If you're a scaler like me, you might want to move to the micros, which is going to be 1/10 the size of all of the E-mini products, whether it's Russell, NASDAQ, Dow, S&P, Bitcoin. And then you have the option of, I think, not to be as price sensitive with the micros. The full E-mini contracts, where I think the advantages are, if you are really somebody who believes really strongly in a price area and you don't need a lot of wiggle room around it. Like for me, I use the E-mini S&P. I don't use the micro because I believe that price in the S&P, when I get to my areas, I want to be executing in a little bit of a tighter range. So I'm quicker in and I'm potentially quicker out. So I'm using a larger contract size and being able to rotate out of them quicker, right? The slippage to me doesn't matter as much because like in the NASDAQ might go 20 points against me and I still may be right in the trade, but I have to take the heat. So I'd prefer to scale in versus the S&P. My stops are a lot closer. So therefore I pick a bigger contract. And ultimately to me, that's a better position to be in. But once again, it's just a matter of choice. I think it's very important for you to look into which one is best for you and your strategy to determine, what is the best solution for execution. Because if you're in a position that you feel is too big too soon and you need a little wiggle room, then micros are great for you, or vice versa.
And would you think, Anthony, and just to tack on, for new traders going from a simulated account who've been practicing trading to a live account and actually trading with a live account, micros might be a good place to start rather than jumping into the big contract?
I think the micros are the best thing to happen for retail traders because the micros are basically a way to start with a very small account and to be able to go in and almost look at that in some ways as simulation, but you have skin in the game and you actually feel the money movement. A $5 per handle move in the S&P may be expensive to some new traders, but the bottom line is you can still participate with some skin in the game. And at the end of the day, you're never going to truly know who you are as a trader. You're never going to really get a sense of your system and your strategy until you trade it live, because sim is sim. It's not real. It's great to get the click-through movements and understand how the market's personalities are. But until you're on the line, your butt's on the line, and there's real money there, you don't really know how you're going to execute as a trader. So the micros are by far the best way to learn trading.
Awesome. Great. Thanks for that, Anthony.
Last thing for today, I want to talk about, if I could share my screen real quick here, is the event contracts. A shameless plug for me to go to my my website, Place Your Trades. We talk about event contracts every day. I'll actually be live in 30 minutes at Place Your Trades talking about when you should choose to trade an event contract. And I think that even before micros, this is probably one of the best ways to learn how to trade futures and or options. And they're on 11 products. And I just think that they're a great tool. And I'm actually going to be talking about those later today, 11:30 at placeyourtrades.com. But event contracts are a $20 option. They are really a true zero DTE. And you then really have to pick a strike and choose whether it's going to close above or below a price. But you could also trade them intraday on the dome. And if you want to see how I do that, I'll do that live later today in about 30 minutes.
Oh, that's great, Anthony. Thanks so much for that, and I hope everybody watching can switch on over to Place Your Trades and see what that's all about. Event contracts, right? Exciting new stuff from the CME. Again, Anthony, thanks so much. We'll see you next week, right?
I will see you guys next week, and I'm going to be in Vegas this weekend at the Money Show. If anybody's there, stop by and say hello. I'll be on a panel Monday morning with Shy Girl and Julia Cordova.
Great, great. I wish I could be there. In the meantime, everybody watching, thanks for coming and have a great trading day.
See ya.